my friends, and welcome back to Boni's Life. It's your host, Boni, and today we are diving headfirst into the turbulent, exhilarating, and sometimes downright confusing waters of the current crypto market. Whether you're a seasoned trader with calluses on your fingers from clicking that mouse, or a wide-eyed beginner wondering what a blockchain is and if you can trip over it, this episode is for you. We're going to dissect this market for the short-term, mid-term, and long-term traders out there. And by the end of this, you'll have a much clearer picture of where we are, where we might be going, and how you can navigate it all without losing your shit or your sanity. First things first, let's address the elephant in the room. What kind of market are we in right now? Is it a bull, a bear, a confused platypus? Well, if you've been paying attention, you've probably felt the whiplash. We've seen some incredible highs, followed by some gut-wrenching drops. The short answer is we are in a highly volatile and indecisive market. It's a trader's paradise and a nervous investor's nightmare. But don't you worry, we're going to make sense of it all. The market has been range-bound for several weeks now, trapped between strong support and resistance levels, creating what technical analysts call a consolidation phase. This is the calm before the storm, and trust me, the storm is coming. Let's start with the big picture, the 30,000-foot view. The total crypto market capitalization is sitting at a whopping $3.05 trillion. That's with a T. To put that in perspective, that's more than the GDP of the United Kingdom. But here's the kicker. It's down 1.2% in the last 24 hours. A small dip, sure, but it's the constant ebb and flow that's keeping everyone on their toes. The 24-hour trading volume is a healthy $139.7 billion, which tells us there's a lot of action, a lot of buying and selling. Bitcoin dominance is at 57.4%, with Ethereum trailing at 11.5%. This means that as Bitcoin goes, so goes the market, for the most part. But we're seeing some interesting divergences, which we'll get into later. When Bitcoin dominance is this high, it typically means that altcoins are underperforming relative to Bitcoin, and capital is flowing into the safe haven of the crypto world. This is a defensive posture by the market, and it tells us that traders are being cautious. Now, let's talk about the derivatives market, because this is where the real action is happening. The 24-hour derivatives volume hit a massive $230.23 billion, which is up an incredible 125% from the previous period. This tells us that traders are actively speculating on the direction of the market. The open interest, which is the total value of outstanding derivative contracts, stands at $129.11 billion. Bitcoin alone accounts for $58.6 billion of that, while Ethereum has $37.42 billion. Solana, the darling of the last bull run, has $7.46 billion in open interest. These numbers are significant because high open interest combined with high volume often precedes major price movements. The market is coiled like a spring, ready to explode in one direction or the other. Now, let's talk about fear. The Fear and Greed Index, our little emotional barometer for the market, is currently at 19. That, my friends, is in the extreme fear territory. It's the kind of fear that makes you check your portfolio every 5 minutes and question all your life choices. But as the legendary investor Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. This extreme fear could be a massive opportunity for those who know how to play it. Historically, buying when the Fear and Greed Index is below 20 has been one of the most profitable strategies in crypto. The last time we saw these levels was back in the depths of the 2022 bear market, and those who bought then are sitting on massive gains today. We've seen a massive spike in liquidations in the last 24 hours, a staggering $750 million, up almost 500%. And the majority of those were longs, meaning a lot of people were betting on the price going up and got absolutely wrecked. To be precise, $579 million of those liquidations were long positions, while only $171 million were shorts. This is a classic sign of a market shakeout designed to liquidate the leveraged traders and create a more stable foundation for the next move. The largest single liquidation was a whopping $38.81 million on Hyperliquid, an ETH/USD position. That's one trader who had a very, very bad day. Over 192,000 traders were liquidated in the last 24 hours alone. Let that sink in. That's a lot of pain, and that pain often marks the bottom of a correction. So, with all that in mind, let's break it down for our different types of traders. Grab your notebooks, because class is in session. All right, my short-term traders, my scalpers, my day traders, this is your playground. You live and die by the minute, the hour, the day. For you, The current market is a goldmine of volatility, but it's also a minefield. So let's look at the 1 hour and 4 hour charts for Bitcoin. The key here is to identify the range and trade within it until we get a clear breakout. On the 1 hour chart, we're seeing a classic consolidation pattern. After the recent drop, Bitcoin has been trading in a tight range between $87,000 and $88,000. The relative strength index, RSI, is hovering around the 44 mark, which is neutral territory. This tells us that neither the bulls nor the bears are in full control right now. It's a tug of war, and we're waiting for a clear winner. For a short-term trader, this means you can play the range, buy at the support, sell at the resistance. But be careful because the breakout is imminent. The funding rates across major exchanges are slightly positive, with Binance at 0.0046%, Bybit at 0.0060%, and OKX at 0.0051%. These low funding rates suggest that the market is not overly leveraged in either direction, which is actually a healthy sign. Your key levels to watch are $87,145, which is the 100-week moving average, and a massive support level. If we hold above this, we could see a bounce, a break below, and we could see a quick drop to the next support at $86,000. On the upside, the resistance to watch is the 50-day moving average at around $90,000. A break above this could signal a reversal and a move towards $93,305. There's also a CME gap that was created when Bitcoin dropped to $86,000 at the weekend open, with the gap extending up to $89,265. Historically, Bitcoin has a tendency to fill these CME gaps, so keep that in mind as a potential short-term target. Your trigger for a long trade would be a confirmed bounce off the $87,145 support, with a clear break above the immediate resistance at $88,000. Your stop loss should be placed just below the support, around $86,500. For a short trade, you're looking for a rejection from the $90,000 resistance or a break below the $87,145 support. Your target on the downside would be $84,099, which is the cost basis of US spot ETF buyers. Remember, in this market, you need to be nimble. Take your profits when you have them and don't get greedy. The market can turn on a dime. A good rule of thumb is to aim for a risk-reward ratio of at least 1 to 2, meaning for every dollar you risk, you should be targeting at least $2 in profit. Now, for my mid-term traders, my swing traders, you're looking at the daily and weekly charts. You're not concerned with the hourly fluctuations. You're looking for the bigger trends. And right now, the trend is, well, it's complicated. We're at a critical juncture, and the next few days could determine the direction for the next several weeks. On the daily chart, we are in a clear downtrend. We've been making lower highs and lower lows since the all-time high back in October, which was 111 days ago. Bitcoin is now down approximately 30% from that peak. We are currently trading below the 50-day moving average, which is a bearish sign. However, we are still holding above the 100-week moving average, which is a critical long-term support. This is the battleground, the line in the sand between the bulls and the bears. The 100-week moving average has been a reliable indicator of long-term trend direction. And as long as we hold above it, the secular bull market remains intact. A key factor for you to consider is the recent wave of liquidations. The $750 million in liquidations, mostly longs, has cleared out a lot of the dumb money and could be setting the stage for a reversal. The market often moves in the direction that causes the most pain, and right now, the pain is on the long side. This could mean we're due for a squeeze on the shorts. Looking at the long/short ratios, top traders on Binance are showing a ratio of 2.02, meaning they are still net long. On OKX, the ratio is 2.27. This suggests that the smart money is still betting on higher prices despite the recent correction. Your strategy should be to wait for a clear confirmation of a trend change. A daily close above the 50-day moving average at $90,000 would be a strong bullish signal. This could open the door to a move towards the major resistance zone between $98,300 and $100,700. On the other hand, a daily close below the 100-week moving average at $87,145 would be a very bearish signal and could lead to a drop towards the $80,000 support level and even the April 2025 low of $76,000. The true market mean price, calculated using investor cap divided by active supply, sits just above $80,000, which aligns with that November low and reinforces its importance as a potential mean reversion level. And don't forget to keep an eye on the global events we'll discuss in a bit. The Fed's interest rate decision in particular could be a major catalyst for the next big move. A dovish stance from the Fed could be the fuel the bulls need to break out of this downtrend. Also pay attention to the Bitcoin ETF flows. We've seen 4 consecutive days of net outflows, with January 21st seeing a massive 8,020 BTC outflow. However, the total inflows since inception are still positive at 611,830 BTC. So the long-term institutional accumulation trend remains intact. And now, for my long-term investors, my hodlers, my diamond-handed heroes, you're not trading, you're investing. You're in it for the long haul. For you, the current market is just noise. But it's important to understand the noise to know when to add to your positions. This is where the real wealth is built, not by timing the market, but by time in the market. Let's look at the weekly and monthly charts. The long-term trend for Bitcoin and the crypto market is still undeniably bullish. We are in a secular bull market, and these corrections are healthy and necessary. They shake out the weak hands and allow the market to build a stronger foundation for the next leg up. Remember, Bitcoin has gone through multiple 30 to 50% corrections in every bull market, and this one is no different. The key is to zoom out and see the bigger picture. The key levels for you to watch are the long-term support levels. The 100-week moving average at $87,145 is a major one. We've held this level so far, which is a good sign. Below that, we have the US spot ETF buyers cost basis at $84,099 and the 2024 average exchange withdrawal price at $82,713. These are all areas where a lot of buyers have entered the market, and they are likely to defend these levels. The Bitcoin exchange balance is currently at 2.47 million BTC, with a net outflow of 378 BTC recently. This continued outflow from exchanges is a bullish sign, as it suggests that holders are moving their coins to cold storage for long-term holding. Your strategy is simple. Buy the dips when the fear and greed index is at extreme fear. When everyone is panicking, that's when you should be buying. You're not trying to time the bottom perfectly. You're dollar cost averaging into your positions. You're accumulating. The fact that we're seeing net outflows from the Bitcoin ETFs in the short term is not a concern for you. In fact, it could be a contrarian indicator. The institutions are shaking out the retail investors before they start buying again. Pantera Capital, one of the most respected crypto investment firms, has said that 2026 will be about consolidation, compliance, and institutional money. This is the year the big players make their moves. Remember, the long-term vision for crypto is still intact. We have major regulatory clarity on the horizon, with the US crypto bill making its way through Congress. The Senate Agriculture Committee is expected to advance crypto legislation soon. We have institutional adoption growing every day. We have the CEO of Ripple saying the market will reach an all-time high this year. We have Standard Chartered predicting XRP could reach $8 in 2026. Bitcoin price forecasts from major institutions range from $75,000 to $250,000. These are not the signs of a dying market. This is the sign of a market that is just getting started. Now, the no market analysis is complete without looking at the global macroeconomic landscape. The crypto market does not exist in a vacuum. It is influenced by everything from interest rates to geopolitics. And right now, there are some major events on the horizon that you need to be aware of. First and foremost, we have the Federal Reserve's interest rate decision on January 29th. The market is expecting them to hold rates steady at 3.5% to 3.75%, with a 96% probability priced in by the CME FedWatch futures. But the real story will be in Jerome Powell's press conference. Will he signal a dovish pause, hinting at more rate cuts to come? Or will he take a hawkish stance, expressing concerns about inflation? A dovish tone would be bullish for crypto, as it would mean more cheap money flooding the system. A hawkish tone would be bearish, as it would strengthen the dollar and make risk assets like crypto less attractive. Morgan Stanley expects the Fed to send a dovish signal by retaining language that suggests easing remains on the table. Then we have the political theater in the United States. The Trump administration's policies, such as the $200 billion mortgage bond purchase plan, are seen as inflationary, which could be good for a hedge against inflation like Bitcoin. The executive order banning large institutional investors from buying single-family homes is another policy that could have ripple effects through the economy. The ongoing regulatory push in the US is also a major factor. A clear and sensible regulatory framework would be a massive catalyst for the crypto market, as it would bring in a new wave of institutional investors. PwC has stated that 2026 is when crypto rules go live globally, with a focus on stablecoins and compliance frameworks. And let's not forget about the good old-fashioned market sentiment. Gold has been on a tear, surging to $5,073 an ounce, up 1.81% recently. This shows that there is a flight to safety in the traditional markets. And while Bitcoin has been underperforming gold in the short term, it is still seen as a digital version of gold, a store of value in a world of fiat currency debasement. The US dollar index is at $97.120, down 0.29%, which is actually supportive for risk assets like crypto. The fact that Bitcoin is seen as underpriced relative to the macro environment is a very bullish long-term signal. So how do you trade this market successfully? Here are some strategies for our different types of traders. For the short-term trader, you have three main approaches. First, range trading. As long as we are in this consolidation phase, you can trade the range. Buy at support around $87,145. Sell at resistance around $90,000. Use tight stop losses of 1 to 2%. Second, breakout trading. Be ready for a breakout. Have your orders ready to go when we break above the $90,000 resistance or below the $87,145 support. The first target on a breakout to the upside would be $93,305, then $98,300. On the downside, target $84,099, then $80,000. Third, scalping. If you have the skills and the stomach for it, you can scalp the small fluctuations within the range. But this is not for the faint of heart. Use the 1-minute and 5-minute charts and aim for small, consistent gains. For the mid-term trader, consider these approaches. First, trend following. Wait for a clear trend to emerge. Don't try to catch a falling knife. Wait for a confirmed reversal, such as a daily close above the 50-day moving average before you go long. Second, swing trading. Look for swings within the larger trend. If we are in a downtrend, you can short the rallies. If we are in an uptrend, you can buy the dips. Use the daily chart for entries and the weekly chart for trend confirmation. Third, position trading. If you have a strong conviction about the direction of the market, you can take a position and hold it for a few weeks or months. But you need to have a clear exit strategy and be prepared to cut your losses if the market moves against you. For the long-term investor, stick to these fundamentals. First, dollar cost averaging. This is your bread and butter. Buy a fixed amount of crypto at regular intervals, regardless of the price. This will help you average out your cost and reduce your risk. Whether it's weekly, bi-weekly, or monthly, stick to your schedule. Second, buy the dips. When the market is in extreme fear, when there is blood in the streets, that's when you should be buying. You're a contrarian. The current fear and greed index of 19 is screaming buy for long-term investors. Third, hodl. This is the simplest and often the most effective strategy. Buy and hold. Don't get shaken out by the short-term volatility. Believe in the long-term vision. The best investors are the ones who can sit on their hands and do nothing when everyone else is panicking. So there you have it, my friends, a deep dive into the current crypto market. It's a wild ride, but it's also a once-in-a-generation opportunity. Whether you're a short-term trader, a mid-term trader, or a long-term investor, there is a strategy for you. The key is to be informed, to be disciplined, and to have a plan. Don't let the fear or the greed get the best of you. Stay calm, stay focused, and stay profitable. Remember, the market is designed to transfer wealth from the impatient to the patient. Be patient. That's all for today's episode of Boni's Life. I hope you found this analysis helpful. If you did, make sure to smash that like button, subscribe to the channel, and hit that notification bell so you don't miss our next episode. Drop a comment below and let me know your thoughts on the current market. Are you bullish or bearish? What's your strategy? I read every single comment and I love hearing from you. And as always, this is not financial advice. Do your own research, but I hope I've given you a good starting point. Until next time, trade smart and live well.